Somewhere in a folder you haven't opened since your first week at your current job, there is a document with your signature on it. You signed it during orientation, probably on the same day you filled out your direct deposit form, chose your health insurance plan, and tried to remember which conference room the bathroom was near. HR handed you a stack of papers, walked you through the highlights, pointed at the signature lines, and moved on to the next slide. You signed. Everyone signs. It takes about 4 seconds and feels entirely routine. What that document actually authorized is a percentage of your retirement savings, money you earned, money you contributed, money you are counting on to fund the last 30 years of your life, being quietly redirected to a fund management company every single year. Not as a one-time fee, every year, automatically, without an invoice, without a reminder, without any notification that it happened at all. The fee doesn't show up as a line item on your statement. It doesn't announce itself. It simply reduces the rate at which your account grows, silently, continuously, and at a magnitude that most people would find genuinely alarming if they ever calculated the lifetime number rather than the annual percentage. My name is William. Today we're going through exactly what that fee is, what it actually costs you over 30 years in real dollars, why the financial industry structured it to be invisible, and what you can do about it before the compounding math runs any further in the wrong direction.
First, what a 401k fee actually is and where it hides. Every investment fund charges what's called an expense ratio, an annual fee expressed as a percentage of your total assets under management. It covers the cost of running the fund, portfolio managers, research teams, administrative overhead, and the profit margin of the institution managing your money. The fee is not charged as a separate transaction. It is deducted directly from the fund's returns before your account balance is calculated, which means you never see it leave. You only see the balance after it is already gone. On any given statement, your account shows growth or loss relative to market performance minus the fee. And the fee is never itemized separately, because itemizing it separately would make it visible in a way that creates uncomfortable questions. The average expense ratio in employer-sponsored 401k plans currently sits between 0.5% and 1.5%, depending on the plan, the employer, and the specific funds offered. That range sounds narrow. The financial difference across it is not. The math, what 1% actually costs over 30 years. This is the section the fund management industry would prefer you skip, which is precisely why it deserves the most attention. Take two investors. Both contribute $500 a month to their 401k for 30 years. Both earn an identical 7% average annual return from the market. The only difference, investor 1 is in an index fund with an expense ratio of 0.05%, the kind available through Vanguard, Fidelity, or Schwab. Investor 2 is in an actively managed fund with an expense ratio of 1%. Investor 1 ends with approximately $566,000. Investor 2 ends with approximately $474,000. The difference is $92,000 from a single percentage point on identical contributions across identical market returns. The only variable is the fee. Now run the same comparison at 1.5% expense ratio, which is not uncommon in plans dominated by actively managed funds, and investor 2 ends with approximately $427,000. The gap widens to $139,000. That $139,000 didn't go into the market. It didn't go toward your retirement. It went to a fund management company as compensation for managing money in a way that, as we'll get to shortly, statistically underperforms the cheaper alternative it was supposed to beat.
The active management problem: paying more for less. The justification for higher expense ratios is straightforward. Active management produces superior returns. Professional portfolio managers, armed with research teams and market expertise, identify opportunities that passive index funds miss. You pay more because you get more. The data does not support this argument. It refutes it comprehensively and consistently. The S&P Indices versus Active scorecards, published annually and tracking fund performance over rolling periods, found that over a 15-year period, approximately 92% of actively managed large-cap funds underperformed their benchmark index.
Not a few funds, not the bad ones, 92% of them, including the ones with the most impressive-sounding names and the highest-paid managers. The reason is mechanical and unavoidable. An index fund that charges 0.05% needs to return 0.05% above its benchmark to break even on fees. An actively managed fund charging 1.5% needs to outperform its benchmark by 1.5% every single year just to deliver the same net return to investors. Consistent outperformance at that magnitude, sustained across 15 and 30-year periods, is statistically rare enough to be effectively impossible to identify in advance, which means the average 401k investor is paying a significant annual premium for a fund that will, with overwhelming statistical probability, deliver worse net returns than the boring index fund sitting 2 columns to the left on the same fund selection screen. Why the fee is invisible. The structure is not accidental. If your 401k statement showed 2 lines, your investment return and the amount deducted in fees, the conversation about expense ratios would happen naturally. The fee would be visible, comparable, and subject to the same scrutiny you'd apply to any other line item in your financial life. The statement doesn't show 2 lines. It shows 1, your balance. The fee has already been removed before that number is calculated. The invisibility is not an oversight in how statements are designed. It is a structural feature of how the financial product is presented, one that has survived decades of regulatory discussion, specifically because making fees visible would trigger the behavioral response that fund companies are financially motivated to prevent. The 401k enrollment process compounds this invisibility. Most employees select funds during their first week of employment, under time pressure, with limited financial context, from a menu of options curated by their employer's plan administrator, who may or may not have selected those options with participant cost as the primary criterion. Many employers choose plan providers based on administrative convenience or institutional relationships rather than expense ratio optimization. The result is that millions of workers are defaulted into high-fee funds, not through any deliberate choice, but through the path of least resistance structure of the enrollment process itself.
What to actually do. 4 steps in order. The first step is finding out what you're currently paying. Log into your 401k account, navigate to your current fund holdings, and look up the expense ratio on each fund. This information is required to be disclosed. It exists somewhere in your plan documents and on the fund's fact sheet. Write down the number. Most people have never looked at it. The second step is identifying whether lower-cost alternatives exist within your plan. Most 401k menus include at least one index fund option, often labeled as an S&P 500 index fund, a total market fund, or a target date fund with a significantly lower expense ratio than the actively managed options alongside it. If your plan offers a fund with an expense ratio below 0.10%, that fund deserves serious consideration regardless of what else is on the menu. The third step is switching your current contributions and potentially your existing balance into the lower cost option if one exists. This is a 5-minute process inside your account portal. It does not require calling anyone, explaining anything, or getting approval from your employer. You select the fund, set the allocation percentage, and confirm. The change applies to future contributions immediately and to the existing balance according to your plan's reallocation terms. The fourth step is addressing what to do if your plan offers no low-cost options at all, which is more common than most people realize, particularly in smaller employer plans. In that scenario, the lever available to you is the IRA. You can contribute up to $7,000 annually to a Roth or traditional IRA at any brokerage that offers low-cost index funds, independent of your employer's plan menu. Contribute enough to your 401k to capture the full employer match. That match is a guaranteed 50 to 100% return that no fee calculation overrides, and then direct additional retirement savings into the IRA where you control the fund selection entirely. The employer match changes the math in one specific and important way. Even in a high-fee plan, a 50 or 100% employer match on contributions up to a certain percentage produces a guaranteed return large enough to justify contributing to that threshold, regardless of the expense ratio. The fee erodes returns at the margin. The match creates them at the foundation. Capture the match first, then optimize the rest. The document you signed during orientation authorized something you were never fully shown the cost of. That's not an accusation, it's a description of how the enrollment process is structured for the majority of American workers. The permission was real, the disclosure was technically present, the visibility was not. The fee has been running since your first contribution. The compounding math has been working against you at whatever rate your current expense ratio specifies for however many years you've been in the plan. You cannot recover the years that have already passed. You can change what the next 30 years looks like. 5 minutes in your account portal, one fund comparison, one reallocation. The permission slip you signed during orientation doesn't have to be the last financial decision you make about money you worked your entire career to build.